In September 2008, Lehman Brothers had $639 billion in assets. 72 hours after they filed for bankruptcy, $46 billion vanished from money market funds that regular people thought were safe as savings accounts. Not because those funds invested in Lehman, because they invested in banks that invested in banks that invested in Lehman. This is what happens when one company can't pay its debt. And it's not what you think. Here's the thing about modern finance that nobody really explains properly. When a big company borrows money, that debt doesn't just sit on a balance sheet somewhere gathering dust. It becomes an asset. Someone owns it, and that someone uses it as collateral to borrow more money. And that next person does the same thing. Your debt is my asset. My asset is your collateral. Your collateral is someone else's guarantee. So when people say Company X defaulted on its debt, what they're really announcing is that a specific asset just became worthless. And here's where it gets interesting. That asset is probably holding up 3 other assets, which are holding up 9 more, which are embedded in a fund your pension owns. The financial system isn't a line of dominoes. It's a Jenga tower where the same 7 blocks are somehow supporting the entire middle section. Let me show you how this actually works. Imagine a company, let's call it Megacorp, issues $10 billion in bonds. Insurance company A buys $2 billion of those bonds. It seems simple. But insurance company A doesn't just hold those bonds. They're listed as assets, which means insurance company A can now borrow against them. So they take out a loan using Megacorp's bonds as collateral. Now, here's where it multiplies. Hedge fund B bought $3 billion of Megacorp's bonds, but they didn't buy them with cash. They bought them with borrowed money, using other bonds they own as collateral. Those other bonds issued by a company that has significant business exposure to Megacorp. Bank C owns $1 billion in Megacorp bonds, but they've sliced them up and packaged them into securities that pension funds bought. Those pension funds valued those securities at par, which allowed them to report healthy balance sheets, which allowed them to avoid hard conversations about contribution rates. Megacorp also has $15 billion in outstanding loans from a syndicate of 12 banks. Those loans are spread across different tranches with different priority levels. The banks sold the riskier tranches to asset managers, kept the safe ones. Except the safe ones are only safe if the risky ones absorb the first losses. Are you starting to see it? Now, Megacorp misses a debt payment. Doesn't matter why, market conditions, bad management, a supplier collapsed, whatever. The bonds drop 40% overnight. Insurance company A now has a problem. The collateral backing their loan just lost half its value. Their lender issues a margin call. Insurance company A has to sell other assets to meet it. Those sales push down prices in markets that have nothing to do with Megacorp. Hedge fund B is underwater on their leveraged position. They have to unwind, but the market for Megacorp bonds has frozen because nobody knows what they're worth anymore. So hedge fund B dumps their collateral, the other bonds, the ones tied to Megacorp's business partners. Now those companies' borrowing costs spike. Bank C has to mark down the value of their Megacorp loans. That eats into their capital ratios. They pull back on new lending to preserve their buffer. Businesses that have nothing to do with Megacorp suddenly can't get credit. The pension funds have to explain to their boards why their A-rated securities are now worth 60 cents on the dollar. Some of them are suddenly underfunded. Contribution rates go up. Hiring freezes happen. And here's the kicker. Megacorp might actually be fine in the long run. Their business might be salvageable, but the debt panic creates a cash crunch that forces them into bankruptcy anyway. The fear becomes the reality. The official story about financial markets is that they're efficient. Prices reflect true value. Risk is distributed. Diversification protects you. The actual story is that the same assets are pledged multiple times across the system. A single bond might be on 10 different balance sheets, supporting 10 different borrowing arrangements, backing 10 different risk models. When regulators calculate bank capital ratios, they're measuring safety based on the assumption that assets can be sold at reasonable prices. But reasonable prices only exist when everyone isn't selling at once. The models assume diversity. The reality is concentration with extra steps. After 2008, we got stress tests. Banks have to prove they can survive severe scenarios. But the scenarios assume one bank fails or one sector struggles. They don't model what happens when the collateral chains seize up simultaneously. Because if they did, the answer would be uncomfortable. This isn't theoretical paranoia. It happens in slow motion all the time. When Archegos Capital collapsed in 2021, they had less than $10 billion in actual assets. But through leverage and derivatives, they had exposure to $160 billion in stocks. When their positions unwound, Credit Suisse lost $5.5 billion. Nomura lost $3 billion. Morgan Stanley, Goldman Sachs, and others took hits. Archegos wasn't even a public company. Most people had never heard of them. They weren't systemically important by any traditional measure, but they'd convinced multiple banks to lend against the same collateral, and when it unwound, the losses radiated outward. Or look at what happened in UK pension funds in 2022. Interest rates rose, bond prices fell. Seems normal. Except these pension funds were using something called liability-driven investment strategies. They'd posted bonds as collateral for derivatives positions. When bond values dropped, they faced margin calls. To meet those calls, they had to sell more bonds, which pushed bond prices down further, which triggered more margin calls. The Bank of England had to intervene with £65 billion in emergency bond purchases. Not because the pension funds were insolvent, because the collateral chain was about to eat itself. Here's what makes this especially strange. Everyone in finance knows this. It's not a secret. Counterparty risk and collateral chains are standard concepts. There are entire conferences about systemic risk, but the system is built on the assumption that it won't happen. Or more precisely, it's built on the assumption that when it does happen, central banks will step in. The collateral might be fake, but the backstop is real, which works until it doesn't, because every intervention teaches the same lesson. You can borrow against anything, leverage everything, and if it goes wrong, someone will absorb the loss. Depositors get made whole. Bondholders take a haircut, but not a scalping. The system survives, so the incentive is always to add more leverage, use more collateral, chain more assets together, because the upside is yours and the downside is distributed across taxpayers, central bank balance sheets, and inflation that shows up 3 years later in grocery prices. The financial system doesn't punish the creation of fragile collateral chains. It rewards it right up until the moment it collapses. There's a question nobody wants to ask out loud. How many layers deep does this go? When the next big default happens, and it will, we'll do the same thing we always do. We'll act surprised, we'll trace the connections, we'll discover that a company we'd barely heard of was somehow central to 17 different borrowing chains. We'll have urgent meetings about contagion and systemic risk. And then we'll add more liquidity, more backstops, more complexity. Because the alternative is admitting that we've built a financial system where one company's debt isn't just their problem, it's the block holding up the tower.